Gold has surged past $4,300 an ounce.
Right.
I mean, that is a completely vertical move. We're talking an astonishing 70% rise in 2025 alone, hitting price levels that, traditional finance hasn't seen in 4 decades.
And here's the paradox.
This is the paradox we have to unpack. It's happening even though U.S. long-term interest rates are holding firm, well above 4%, and real yields are positive.
Mm-hmm.
Conventional financial theory just screams that this shouldn't be happening. I mean, this inverse relationship, its collapse, is seen as fundamentally impossible.
It is impossible, but only if you assume the old rules of sovereign trust still hold.
Right.
That anomaly, that vertical move in an asset that pays you nothing, it signals something much more critical than just a simple inflation hedge.
So what is it?
It's the systemic, structural erosion of faith in the world's primary fiat currency. This move it's a market measure of pure geopolitical risk.
This is Neural Pulse. Let's analyze. Our sources indicate that the most acute pressure point right now is the Indo-Pacific. The whole nature of conflict there has fundamentally shifted.
It really has.
We're moving away from that sort of catastrophic, high-risk invasion scenario and more toward these calculated, low-threshold blockade tactics.
That is the crucial strategic shift. Let's look at the facts from that recent Chinese PLA military exercise. It was codenamed Justice Mission 2025 right at the end of December.
And the intent was different this time.
Completely. This wasn't a rehearsal for a full military invasion. It was explicitly for a physical blockade and a quarantine of key energy and trade routes around Taiwan.
And what really gives away the intent is the composition of the fleet they used. They included 14 China Coast Guard vessels. The CCG is a maritime law enforcement arm, not a naval fighting force.
Exactly. And they were there for quarantine pre-rehearsals. That tactic keeps the entire action in this gray zone, below the clear threshold of a declared war.
But it has the same paralyzing economic effect on shipping.
It does. And that gray zone pressure, it demanded an equally dramatic display from the U.S. We saw this unusual concentration 3 carrier strike groups in the Western Pacific, the Lincoln, the Vinson, and the Washington.
That's a huge concentration of force.
It is. That triple CSU presence just shows you the gravity of this shift. It forces the U.S. Navy into this incredibly expensive, high-tempo deterrence posture just to maintain the status quo.
The vulnerability that China is targeting here is, it's so clear. It's about energy. Taiwan has this critical weakness, 97% reliance on energy imports.
And specifically, its vulnerability to liquefied natural gas, or LNG, is acute.
How acute?
Taiwan has only about 11 days of peak summer supply of LNG stored on the island. And that timeline, it's getting drastically shorter because of the 2025 shutdown of the Ma'anshan nuclear plant.
So there's a gap.
A huge one. The 2026-2027 period is Taiwan's unavoidable energy security gap. The CCG's quarantine drills are designed to choke the key import hubs like Kaohsiung and Taichung. They can effectively make safe commercial passage for an LNG tanker, non-existent.
So if we zoom out from the island itself, what does this constant threat of a blockade mean for, say, a corporate decision maker listening to this?
It links directly back to the persistent global inflation that we're all wrestling with.
How so?
These military exercises, they instantly increase war risk premiums for shipping across the entire region. And those premiums, they don't just disappear, they translate directly into higher freight rates.
Which becomes cost-push inflation.
Exactly. Our forecast now shows U.S. inflation remaining structurally above 3%, largely because of these geopolitical cost inputs.
And this kinetic pressure, while it's focused on Taiwan, it's also China's countermove against U.S. high-tech sanctions, isn't it?
Absolutely. This is non-symmetric retaliation. Washington has been very aggressive, restricting access to advanced semiconductors, especially HBM high-bandwidth memory.
Which you need for AI chips.
It's the foundation for AI chips. They also put dozens of Chinese firms on entity lists. So China's response is to raise the physical cost of doing business for U.S. allies in the region. They're using economic paralysis as leverage.
The ultimate consequence here seems to be an accelerated new status for the Taiwan Strait.
It's accelerating toward becoming a de facto internal sea managed by China. And this forces the world's semiconductor giants, especially TSMC, to face this urgent binary choice.
Stay or go.
Pretty much. Either pay the massively rising costs to stay and operate under what is essentially Chinese management, a huge sovereign risk, or commit to a full-scale multi-billion-dollar decoupling off the island.
And that very need to find new anchor points for massive amounts of capital, Well, it shifts our focus to the next major market mover, the one that just ended 30 years of global financial history, Japan.
That's right.
We're now looking at Japan, which, for decades, was the global liquidity anchor, providing all this cheap capital to the world.
That era is over. And it's just compounding the instability we're seeing elsewhere.
The Bank of Japan made a truly historic pivot on December 19, 2025. They raised their policy rate to 0.75%.
To really understand how big a move that is, you have to remember this is the first time the rate has been above 0.5% in 3 decades.
30 years.
And the 10-year Japanese government bond yield, which everyone expected to stay near zero forever, it briefly shot past 2%.
That is a massive policy turn. What finally made them do it? What broke 3 decades of inertia?
It was really 3 things. First, domestically, you have inflation persistently over 2%, but crucially, real wages for Japanese workers have been falling. That creates immense political pressure.
Okay, so that's one.
Second, there's a strategic angle. They likely want to get ahead of criticism from the new protectionist U.S. administration over trade surpluses, so they let the yen strengthen.
And the third.
The core strategic reason is this paradox of normalization pain.
Normalization pain. What do you mean by that?
Japan realized its incredibly cheap credit was just propping up unproductive zombie companies, firms that only survived because interest was basically free.
Right.
By raising rates even a little, they're forcing the liquidation of that dead weight. The idea is to boost overall productivity. It's painful short term, but it's seen as necessary to finally exit the lost 30 years.
But doesn't that kind of forced liquidation risk a really sharp, sudden deflationary shock? Couldn't that just delay normalization even further?
Oh, it absolutely carries that risk. The market is watching this very closely. But it seems the strategic decision is irreversible. The risk of staying stagnant just became greater than the risk of a painful correction.
And this isn't just a domestic issue.
Not at all. This triggers a global liquidity shock. It's known as the yen carry trade unwind.
Can you explain the carry trade unwind for us?
Sure. Imagine for 3 decades, Japan has been the world's bank, offering a credit card with a near-zero interest rate.
So global investors borrowed yen for almost nothing and then bought much higher-yielding assets like U.S. Treasuries.
Exactly. Now, that credit card is suddenly charging 0.75%. The interest rate gap between the U.S. and Japan is shrinking. So Japanese investors are now incentivized to sell those foreign assets, bring the capital home, and pay off their debt.
And when Japanese institutions who hold trillions start selling U.S. Treasuries, that pushes U.S. long-term yields even higher.
Precisely. U.S. long-term yields are already hovering around 4.17%. This unwind just accelerates U.S. recession risk by making it more expensive for everyone in the U.S. to borrow money. Japan is going from being the global liquidity anchor to a major global volatility factor.
And that instability, created by Japan's sudden pivot, coupled with all the friction in the Pacific, it brings us right back to our opening data point.
The runaway gold price.
Right.
We have to understand this. Gold is no longer acting as just a hedge against inflation. It has become a necessary hedge against systemic sovereignty risk.
The facts here are startling. Gold is over $4,300 an ounce, and this massive move is being driven almost entirely by central banks.
It's all official sector demand.
The pace of buying is just unprecedented. We're forecasting an estimated 585 metric tons purchased per quarter in 2026. That's roughly double the historical average.
And we know who the key buyers are. It's not retail, it's China, it's Russia, and countries all across the global south.
Why the rush?
The driver is this profound structural distrust in the U.S. dollar and in Treasury debt. I mean, just look at the staggering U.S. fiscal situation. The deficit hit $439 billion in just the first 2 months of fiscal year 2026. The debt trajectory is seen globally as unsustainable.
But the real catalyst wasn't the debt itself, was it? It was the political weaponization of the dollar.
Absolutely. That was the pivotal moment. The 2022 freezing of Russian dollar reserves. That one action instantly transformed the dollar from a neutral economic tool, a safe place to park your wealth, into a direct geopolitical liability.
So for any country not perfectly aligned with the U.S.
For any non-aligned nation, holding massive dollar reserves is now a strategic risk. It's forcing them into what you could call a collective sanctions avoidance strategy. And the primary tool for that is gold.
Which explains the paradox we started with. Why high real interest rates aren't stopping gold's climb.
Because central banks are making a rational choice based on a very vague hypothesis, that the U.S. debt burden is so immense that eventual financial repression is inevitable.
And what does that look like in practice?
Financial repression means the government accepts or even encourages sustained high inflation to intentionally erode the real value of its outstanding debt.
So they inflate it away.
They inflate it away. They are prioritizing principal preservation in a real asset like gold over the return they might get from an interest-bearing paper instrument. If you believe the dollar's purchasing power will be intentionally destroyed over the next decade, you buy the one asset that can't be printed.
The consequence for global trade seems pretty clear. The dollar is no longer the only choice.
That's right. We're seeing this accelerating use of non-dollar trade systems like mBridge, that platform for cross-border transactions using central bank digital currencies.
And this is filtering down to the corporate level, too.
It is. Corporate treasury standards are changing. Diversifying holdings into what we're calling sovereign-neutral assets like gold, maybe even digital assets like Bitcoin, is moving from a fringe idea to a standard risk management technique for major corporations.
So if financial assets are being reassessed for sovereignty risk, it makes sense that the physical resources underpinning national power are too. And that takes us to Africa.
Exactly. We're seeing a new resource war unfolding, one that's challenging Europe's critical energy independence pivot right in the Sahel region of Africa.
The reality on the ground is stark. The Sahel States Alliance, that's Niger, Mali, and Burkina Faso, has decisively broken ties with France.
And the most critical action came in December 2025. Niger's military regime effectively halted all uranium exports to France. Then they went a step further and nationalized key mining interests, specifically the Sommier mine, which directly hits France's state-backed Orano company.
This has to be a devastating structural shock to European energy security.
It truly is. France relies on nuclear power for 65% of its electricity. Niger historically supplied up to 20% of its natural uranium. This is much more than just a coup. It feels like a second war of independence from that old Francophilic system.
And into that power vacuum, Russia has stepped in.
Immediately, the vacuum is being filled by Russia's Africa Corps, which is essentially a state-backed mercenary force. They're exchanging these comprehensive regime survival packages for access to mineral rights, uranium, and gold.
So they're trading security for resources.
They're trading short-term political protection for these new military regimes for long-term mineral access.
Which creates a devastating paradox for Europe's entire energy strategy, doesn't it?
It's an incredible paradox. Europe pivoted hard to nuclear power after the 2022 Russian gas crisis, seeking energy autonomy.
Right.
And now they find the critical fuel source, uranium, falling under Russian influence. They thought they were securing independence from Russian gas, but they just swapped one dependency for another. And the only certainty is increased European nuclear energy costs.
And this instability inside the Sahel, it has immediate external consequences.
It creates a new global choke point concern. This instability is fueling Russia's potential corridor of autocracy, running from these landlocked states through war-torn Sudan right to the Red Sea at Port Sudan.
So it projects Moscow's influence outward.
And it simultaneously increases migration pressure on Europe's southern border. It connects all these dots.
And that strategy of integrated warfare links these physical choke points with, well, sophisticated cyber disruption. We have to look at the Middle East and this escalating invisible war.
The physical choke points are still under immense stress. The region is on a knife's edge after the Israeli-Hezbollah ceasefire expired in late December.
Right.
Israel's claims of violations keep the region on the brink of major military action, and at the same time, Yemen's Houthis continue their attacks in the Red Sea.
We can now quantify the effect of those attacks. Maritime trade growth is basically stalled at a minimal 0.5%. That's down sharply from 2.2% in 2024. It's forcing this sustained, costly diversion around the Cape of Good Hope.
And while that physical risk is simmering, the invisible war is escalating. The focus is shifting to the cyber domain, specifically on China's state-sponsored group, Volt Typhoon.
What are they doing?
They are continuously confirming deep intrusions into U.S. critical infrastructure. We're talking power, water, transportation networks.
And the threat here isn't just about stealing information, it's about planting the ability for future disruption.
Exactly. Their technique is what the industry calls living off the land.
Meaning?
It means they use legitimate built-in system tools that are already on the network to move around and evade detection. They aren't bringing in obvious malware, they're just planting these digital time bombs deep inside the network layers. This isn't espionage, it's pre-positioning for sabotage.
And this sophisticated cyber activity, it links directly back to the physical military plans we discussed earlier around Taiwan.
It's the critical non-kinetic half of the Taiwan plan. If tensions escalate, these cyber attacks on U.S. ports, on power grids, on logistics, they're designed to maximize the cost and the delay of any U.S. military response. It's a core part of their A2AD strategy, but using digital paralysis to slow mobilization.
This elevates cyber risk from just an IT issue.
It elevates it to an existential business continuity plan problem for every major company operating in the U.S.
And the consequence for corporate balance sheets, especially given the state-sponsored nature of this, must be severe.
We have to issue a very clear warning on this. Cyber attacks that are driven by clear geopolitical motives, what are deemed acts of war, are increasingly likely to be excluded from standard cyber insurance policies.
So the risk falls on the company.
It places the burden of managing and mitigating this systemic risk squarely and irreversibly on the corporate balance sheet. The government will not absorb this risk. You must. So if we synthesize these 4 points, 2026 is being defined by structural disruption. The response has to be structural adaptation. Logistics disruption around Taiwan, for example, is no longer a tail risk you manage. It's now a prerequisite for your business continuity planning.
Right.
The collapse of U.S. fiscal discipline means dollar erosion is a long-term structural reality, and cyber activity is already integrated into active military war plans around the globe.
So the essential action for global decision makers shifts from speculation to what you could call fundamental asset defense.
That's a good way to put it.
It means moving funds from traditional paper liabilities and unsecured treasury holdings into material, real assets, physical commodity exposure, supply chain redundancy, and sovereign neutral assets. Things that cannot be sanctioned, printed, or digitally frozen by a foreign power. It's about moving capital into what can be held, not just what is promised. Neuropulse. Clarity in a complex world. See you tomorrow.